Hello, I'm the Investing Scotsman. Welcome to the very first episode of my channel. The question I'm asking today, and I hope to answer over the next 15 years, is have I left it too late in life to start investing? Obviously, the sooner you start investing, you start saving, and you start getting the benefit of compound growth, the better. So I've probably missed out on a good 20 years worth of doing this. So let's just see how it goes. The idea behind this channel is simple. I'm going to show you what it's like starting from nothing, trying to build an investment portfolio. I'm going to document every step, the good, the bad, and probably some downright stupid things. Nothing here is financial advice. I'm not a financial expert, advisor, or some would say very good with finances. So please do your own research and be aware of the risks involved. So this very first month I've not put a lot of money away, and realistically I probably won't be adding big sums of money in the next little while. But I've started off £103.46 invested, and already I've lost £1.08 on that investment so far. And this is really the reality of investing. You know, like over the long term, you're betting that the stock market's going to go up. Over the short term, it's going to go up, it's going to go down, it's going to stay sideways. There's going to be good years, good months, bad months, and really, if you start early enough, you're going to be able to absorb those risks. I've lived through the dot-com bubble. I've lived through the 2008 housing market crash. There was the whole COVID era and the dip in the market afterwards. And now there's suspicions that the big tech companies are part of an AI bubble and the stock market might suffer. Over the long term, when there's a dip in the market, and if you're still investing, you're effectively buying cheap stocks, and those over time, you're hoping, you're betting that they're going to go up again. So I'm still early enough in this journey, I'm 2 weeks in, and I'm happy to see some losses at this point. It's no, it doesn't matter here, or it's a little bit. It doesn't make a big difference. As I get closer and closer to retirement, that's where I'm going to start thinking about risk profiles and potentially coming out of stocks, going into bonds, or starting to take some cash. There'll be thoughts, considerations then, as well as the value of the stocks, and whether they've gone up and down in value. You can also see there's dividends, there's passive income. Now, I'm not looking to invest to earn passive income at this point. If the pot grows big enough in 15 years' time, that might be a consideration towards early retirement. But for now, I want to see the dopamine. I want the dopamine hit of seeing some of that income coming into the account. It's getting invested straight away. It's just going to come into my account and get reinvested back into the stocks. So really, I'm looking to grow the investment portfolio. I'm not looking to start taking any dividends out, because £3.22 a year, that's not going to pay a lot of bills, is it? So the investment funds themselves, portfolio that I've started with, I've gone for 35% VUSA. So this is the S&P 500, big American, mostly tech-heavy companies. It's been one of the strongest markets for years, so it's a pretty safe bet. I think I might bring the percentage of this down over time. Just I think it's with fears of the AI tech bubble. I don't want to be all in America, all in the big tech companies. Secondly, we've got VWRL. I've got 25% of my investment there. It's basically a global fund. It's US, Europe, Japan, and emerging markets, so it's a bit of a balance. It's got a wee bit less of the US dominance and more worldwide coverage. I've got JP Morgan's Nasdaq Equity Premium, 15% in there. It's a bit more concentrated, actively managed US growth. It's a bit of variety. It's got some potential upsides beyond the ETFs that have gone into here. I also have JP Morgan Global Growth and Income, 15%. So it's another active fund that spreads the risks across markets, and it's a slightly different flavour of companies that are held in there. So again, try to get some more income exposure with a bit more diversity in there as well. And I've also gone 10% into the VFEM, that's emerging markets. So it's just a small slice. This is it's more volatile markets, but over the long term there is potential for higher growth. So it's a bit of a mixed bag. It's maybe not the most diversified, but I'm trying to go in for some of these ETFs at the minute rather than investing into single stocks, which may boom, but they also might bust. Realistically speaking, how much could I be looking at in 15 years' time? Here's a simple growth chart. If I were to invest £250 a month consistently, so a little bit more than I'm investing now, if I were to do that, reinvest all dividends, I can save about £50,000 in the next 14 years. The time you adjust that for inflation, that's about £80,900. So it's not nothing, but it's not the mega bucks that you might hear on some other channels, where people have been already investing for 20 years and have another 20 years ahead of them to invest. This also isn't a guarantee. I might do better, I might do worse, so come along and let's find out. If you want to follow along, please leave a subscribe below, and you'll be able to find out how I'm getting on a monthly basis. So the first update will be coming at the end of November. I'm also using a trading platform called Trading 212. I'll leave a link in the description below if you want to sign up, if you're interested in it. Use the link below and you and I will both get a fractional share worth up to £100 each. Thanks for watching, catch you next time.